looking at a particular company fundamentally. And one thing the team has started doing recently is when managing directors and the like have been in Melbourne, or perhaps their company's based in Melbourne, we've been going out to interview them and talk to them about their companies. Okay, so we're really grasping this fundamental side of things, but it's certainly not my area. I'll be the first to admit. This isn't better than TA, technical analysis, and I wouldn't suggest technical analysis is better than this. They're two very different approaches. And you can put forward a fairly strong argument to suggest that a combination of both is probably the best approach. Combination of the fundamentals behind a good company and the chart doing the right things is probably the strongest approach you could ever have. So again, we've got some more stuff we can look at, fundamentals. You know, companies have to declare when their directors buy and sell shares, and that can provide some very interesting insight to when two directors have just sold some shares in the last week, and the secretary just resigned yesterday, and you know, all these little things that can perhaps lead you to form an opinion, whether it's right or wrong, on perhaps the future or the sustainability of a particular company. Just on profits, if I may, there are so many companies out there that don't make money on the exchange. Just because they're on the exchange, don't think they're going to make money and provide you dividends. Not at all. Right? There's so many companies that have never made 1 cent on the exchange. That's why they're on the exchange, some of them, because they need more money to be invested to keep going. Certainly it's a lot of biotech sort of things. Okay, so what do we need to do? Obviously we need to look at our own personal circumstances and clearly look at what our objectives are and what we're trying to achieve in the market. Are we going to be a trader who trades on a very regular basis using a short-term instrument with leverage and in and out often and quickly and taking advantage of very short price movements or quick price movements? Or perhaps more a medium-term, longer-term, conservative approach, perhaps ideal for your self-managed superannuation fund, for example. So what is your approach? Because they're two very different approaches. Completely different, based on time and where we put exits, and all sorts of things are very different. I'm a big believer in getting educated, huge believer in you need to educate yourself. Remember, we think trading's easy money. No, it's probably the hardest easy money there is. Okay, it's not that easy. And it comes down to one thing, which I'm going to talk about before I finish today. And unfortunately, what we think about the price of a stock, no one really cares about your opinion, sadly. That's the harsh truth. Okay, so if you buy something at $4 and within a month it's down to $3.20, deep down you think it's not worth $3.20. I just paid $4 for them a month ago, and they've come out with nothing to suggest that their price should have gone down X% in the last month. But again, all of that doesn't achieve anything because no one cares about your opinion. The market is always right. Always, whether you like it or not. Just to summarise, pardon me, this is what I believe is the composite profile, the typical losing trader. And as you work your way through this, think of the exact opposite, because that's the profile of a winning trader. Okay, losing traders tend to not think about direction, and they're only interested in going in one direction. Now that's a very, it's a time-tested approach, investing, seeing prices go up. But I think we can do better than that, I guess. We can go through periods of time where the market falls for 2 or 3 years, and we've actually made a lot of money by going in either direction. Can't accept losing trades, which is sad because you're going to have a lot of them. But we keep them small, remember? Losing trades we get rid of real quick. I guess, again, it's that trading is easy money, so we really don't need assistance. And I like this one. We're frugal with our capital and our money when it comes to investing in ourselves and our self-development and educating ourselves. But when it comes to taking risks, we don't really care about our money, right? We're quite generous when it comes to taking risks. We think about the money. I don't want you to think about the money. If you think about the money, think about protecting it, looking after it. So we don't think about probability. We do unfortunately allow our emotions to overly influence what we do, and we don't have a methodology. I'll say it again. All consistently profitable traders have a trading plan. Full stop. No discussion to be entered into it. That's it. That's the reality. Okay, so let's reverse all that. And we'll go through the typical or composite, I guess, profile of a winning trader. We don't care about direction so much. We are open to the idea of making money when prices have fallen or are falling. And there's so many that have fallen in the last 6 months or so. And we can put ourselves in a position to financially benefit from that. We can, by trading a slightly riskier instrument beyond shares and trading a derivative product. We can do it, absolutely. So we don't think about direction. Losses we accept as just the reality, and they're going to happen often, and we just deal with them in the best way that we can. We certainly do seek outside help because we know that perhaps it's not as easy as we first thought, and that was certainly my situation. After a few losing trades, I was just frustrated because I thought this was going to be quite easy, and it didn't work out to be that way. And it really, I guess it humbled me, but it also frustrated me because I didn't know why it wasn't working. So I certainly sought help in the early days back in 98 and 99. They're certainly very protective of their capital. They think about probability, entering probability trades. Don't quite trade with our emotions because we're not robots. We just minimise the influence of our emotions in our decision making, and we certainly do have a proven methodology that is going to work for us and we follow with a lot of discipline. Okay, so here's just a quick snapshot, I guess, of how we can separate those groups of people. We have a methodology, we get good information, and we take action. Pablo Picasso said, action is the foundational key to success. Action, take action, just do it. Okay, take action, certainly educate yourself. Okay, to finish off this morning, ladies and gentlemen, and anyone who's heard me talk before, these are not new. And there'll be someone looking just like myself in 100 years' time doing a presentation similar to this one, and before they finish they'll go through the trading rules and they'll be exactly the same. Exactly the same. These rules have stood the test of time, and they're very, very simple concepts. So here they are. First one I've already spoken about a little bit is the idea of cutting losing trades. Of all these rules, that's probably numero uno. That's probably the most important thing you can do, is to cut trades that don't work out for you. Equally, when a trade does work out for you, don't be quick to close that trade to realise the profit. You need to take every advantage of a price moving in your favour. Okay, and if anything, do a better thing, and that is actually buy more and put more money into the trade that's moving in your direction. Follow the trend. In other words, when we see a price moving in the direction that we saw, perhaps Fortescue Metals or Centennial Coal, when we see a price moving in the right direction, we want to jump on board that. Right? That's a price trend moving in a particular direction. So I believe in trading with the trend. Don't force the action, don't overtrade. If the market conditions are not right, don't go looking for opportunities that simply are not there. I can tell you, personally, from just before Christmas through to March, I didn't pay 1 cent in commission. Because my trading plan wasn't presenting me any opportunities, because the volatility had blown out. Right? So the volatility increased significantly, and it got to a point where my plan didn't tell me to trade. So that's just my personal view. So what I did was I didn't force the action. It's easy to look at the market and think, I haven't bought anything for a week. I'm calling myself a trader, I'm going to go and find something. That's ridiculous. Don't force the action. Don't overtrade. Never blindly react to a tip. Has anyone done that? Disastrous. Better than that, don't give them either. I think they're worse, because I've done that early on, and I reckon that's worse than actually responding to one. Demand liquidity, so demand active turnover. There's a lot of stocks, 2,000, many of them are illiquid. They don't have active turnover. They don't have a lot of money being transacted with buying and selling of shares. And if you own some of them and you need to sell, there may not be one person willing to buy them back off you. Well, that's a situation that is best avoided. So demand liquidity, active turnover, look, all the top 50, 100, 200 are very, very liquid. Millions of dollars are traded on them every day. Keep your position small, so again that idea of breaking your capital into small pieces. Don't buy something just because it looks cheap. If it's cheap for a reason, and you can always get cheaper. Always get cheaper. Don't think, oh, that's a big company and it'll never fall below $10. If there's enough people willing to sell those shares, it will fall below $10. And a new one that I've just introduced to my rules, and that is keep it simple.